Hey everyone. So the Fed minutes just came out. Right now, it is market hours on Thursday, April 7th. $95 billion is the number of the day. That's the amount the Fed's going to shrink its balance sheet. So if they kept up for a year, we're talking $1 trillion of selling. Now their balance sheet's it's over 8 billion, but we're talking a significant amount of selling. So here's the thing. Who is it going to hurt? What asset is it going to hurt? What asset is it going to help? Because not understanding this, you will just react to information and end up hurting your portfolio. So stick around, we'll talk about that and so much more. All right, everyone, RC Peck here with Fearless Wealth. We are going to jump over to the price charts, and we're going to really, the frame of this video today is 95 billion. What does that do? Who's it going to affect? And is it even affecting markets the way we think? So let's do this. Let's just start with the S&P 500. Now, as I said, or I believe I said, I'm recording this during market hours on Thursday, April 7th. You're going to get this on the 9th. So the first thing I wanted to know was, how is the market reacting? Like, this is news. This is $95 billion where the Fed's saying, look, we're not going to buy. We knew that. Now we're going to sell almost $100 billion worth of bonds every month. So they're going to sell 60 billion of treasuries a month, and they're going to sell 35 billion of mortgage-backed securities. So the first thing I want to know is, what does the stock market think? What does the S&P 500 think? Well, as of right now, it's up for the day. So it got the news, the market got the news, and it's up. Now it's only up 0.25%, but that tells me that was not bad news. Because here's the thing. One of the things I teach in my coaching course is you don't get to decide what is good news or bad news. The market decides what that is, and you have to know how to ask the market. So far, the market's like, yeah, 95 billion. Now, notice I'm looking at the stock market. But the stock market right now is like, yeah, I don't have a problem with that. Even if you look at the NASDAQ 100, it's about flat for the day. As I look at this right now, it's down 0.06%. So that's also saying, yeah, you know what, that 95 billion is not going to bother. Now, the question is, who is it going to hurt? So this is the bond market. This is basically the US bond market minus inflation protected treasuries. This is a problem. Now, I really want to show you this without the dividend reinvested. So this is what I want to show you and what you have to get really, really clear, especially if you're over the age of 50. Bonds stopped going up pre-COVID. This is the COVID peak right there, meaning the price of bonds peaked right there, and then COVID happened. Notice bonds were not a place to protect yourself during COVID when the stock market fell 35%. Yes, bond prices went up, but notice they did not sustain. They could not keep themselves above that price. And since then, they have been falling. Use whatever word you want: falling, crashing, collapsing. This is the worst start to the year ever for bonds. Whether you look at US aggregate bonds or global aggregate bonds, bonds are taking it on the chin repeatedly, and they're down today on the news. Now, they're not collapsing, but they are down 0.25% today. That's not good. If we look at mortgage-backed securities, which that's the other thing, the other type of instrument the Fed is going to start selling, 35 billion a month. Here's mortgage-backed securities via the ticker symbol MBB. I didn't even take out dividends reinvested yet. Here, I'll do it right here. And you can see that mortgage-backed securities are in trouble. They were in trouble before today. That is accelerating to the downside. Not only did mortgage-backed securities were not able to sustain itself above the pre-COVID high, the bottom blue line is the COVID low. It has collapsed below the COVID low and is accelerating. Now, I don't know where it's going. I don't know how far it's going to go. And the reason is I don't know how far it went up because of the government buying. Now, at least this symbol's only been around since 2007, but it does not look good. Even if we look at inflation-protected treasuries, which were the last holdout of any place in the bond market where you could hide your money, and those have done a triple top, and now they are breaking down again, below their low in February. So here's the first big takeaway. Bonds are to be avoided. Bonds are to be avoided. As far as the stock market goes, it is just going sideways. That's it. Sideways is not bad. Sideways means the stock market is digesting information. Now, what this also means is the Fed has some cover to raise rates, right? So it's kind of locked in now that the Fed is going to raise rates by 50 basis points or 0.5% in May and June and July. And the reason they're able to do this is because there's literally more job openings than unemployed people. There is 5.34 million more job openings, right, than unemployed. So there's an extra 5 million job openings above and beyond, unemployed people. That's also going to allow the Fed to raise rates at 0.5% a clip, probably May, June, July. So expect that. And I also believe the market has already priced that in. I'm going to leave you with two things, and then let's wrap this up so this week's video does not go that long. I want to talk about a stock that is just absolutely crushing it, and it's Costco. So Costco's $270 billion market cap, it just made new lifetime highs. We can add a story to this, we can add a narrative, but I think the answer is people are flocking to Costco because that's where they're still getting the best prices. Maybe that's where inflation is showing up the least right now, and they're buying all their gas from Costco. They're buying all their goods from Costco. Staples are doing well, but Staples are not doing as well as Costco. Here's XLP, which is the Staples ETF, and it has broken out to new lifetime highs. By the way, when a part of the stock market is breaking out to new lifetime highs like Staples or utilities, or here's S&P low volatility, which is kind of like Staples and utilities, that's also a sign of strength in the stock, like the overall stock market. So Costco is absolutely crushing it. I mean, who doesn't like going to Costco? And then lastly, let me just throw in gold. The market's open. Gold also heard about the $95 billion that is going to be getting liquidated by the Fed. And gold has for sure right now stabilized. Now, here's what's more interesting about gold, not the price of the actual metal, but you have the largest gold mining stock. I believe it's the largest gold mining stock in the world based on ounces produced and market cap. And what you're looking at there, this is Newmont Mining. What you're looking at there is a new lifetime high. It's broken out of major upside resistance. There it is right there. Could not stay above 67, but now it finally is, and it's moving to the upside. So gold is definitely more and more in the hands of the strong, people who want to collect it. People are buying. The other good news is, this is the mining companies. So the fact that mining companies are breaking out to new lifetime highs before gold, that tells us more that gold's new price above 1900 has more stability in it. Okay, so let's do this. We have to wrap this up. So the first is the Fed has fully told us what it's doing. The notes came out today. The stock market is totally fine with it. And that information is actually even kind of positive. The bond market continues to take it on the chin. If you are a man or a woman over the age of 50 with more than $500,000 in the market, that means a lot of your money is in bonds, and that is absolutely going to hurt you, potentially hurt you over the next 10, 20, 30, 40 years. Yes, I'm saying that because the older you get, the more your conventional advisor will tell you to put them into bonds. The problem is that entire asset class potentially has already peaked and is in a 40-year, now we're probably 2 years into the 40 years, a 38-year bear market, meaning that portion of your portfolio, whether it's 30, 40, 50%, is actually going to do more dragging you down than anything else. And we've seen that where when the market takes these really sharp corrections, the bond market's not going up. It's getting hit just as badly. So we really have to understand how to read price. But the big news, I think, or at least the kind of the cleaning this up, landing this plane, putting a bow tie on this is the stock market has received the $95 billion number as a positive piece of news. The unemployment rate relative to how many open jobs there are in the United States gives the Fed cloud cover to continue to increase rates, which will put more downward pressure on the price of bonds. Thanks everybody for being in my world. I do appreciate you. Leave comments. I will put some more videos together based on the questions that are coming in. And if you like this video, you will love our other videos. Please subscribe. It's free. Hit the like button. It makes a difference. Thanks for being in my world, and I will see you on the next video. Okay, bye.